Hey everyone, and welcome to The Explainer. Today, we are going to pull back the curtain on something called exchange-traded funds, or ETFs. Look, if you're an Aussie and you're searching for a smart, straightforward way to start building some real wealth, you've come to the right place. So, let's just dive right in.
All right, I'm going to start with a question for you, and it's a big one. Is the money just sitting there in your bank account actually making you poorer? I know, it sounds a bit dramatic, doesn't it? But for most of us, the answer is, believe it or not, yes. And the culprit? It's this silent thief that's been nibbling away at your savings every single day.
Well, that thief is something we call inflation. At a 5% rate per year, which we've been seeing, that crisp $100 bill you've got, in just 3 years, it's only going to buy you what $85 buys today. Think about that. If your cash is just parked in a bank account, it is actively losing its power. So how on earth do you fight back?
Simple. You fight back by investing. And for anyone just starting out, there is one particular investment vehicle that really is the perfect first car, if you will. It's designed to be simple, it's effective, and it helps you dodge some of the biggest risks right out of the gate.
So you could try picking individual stocks, right? Put all your eggs in one basket, maybe bet on one company you think is going to be the next big thing. But man, is that risky. It takes a ton of research, and if that company takes a wrong turn, poof, your investment could get sliced in half. The much smarter play, especially when you're just starting out, is to spread your money across hundreds of companies all at once. We call that diversification, and it's the magic behind an ETF.
Okay, so what exactly is an ETF? The easiest way to think about it is like a shopping basket. Instead of going down the aisle and picking out one apple, then one orange, then one banana, you just buy a single basket that's already jam-packed with hundreds of different fruits. You get a little piece of everything in there, all with one simple purchase on the stock market. It's as easy as buying a single share of any company.
All right, pay close attention here because this might be the most important slide we look at today. You see, not all ETFs are built the same. The single biggest difference? Fees. And it's a huge deal. Look at this. A fee that looks tiny, less than 1%, can literally cost you over $80,000 across your investing life compared to a low-cost fund. That's a car. That's a house deposit. Bottom line, fees are an absolute wealth killer. Always, and I mean always, look for the low-cost option.
Okay, so you're on board. You're going to go for a low-cost ETF. Awesome, but now you search online and, whoa, there are hundreds of them. Don't panic. To make it simple, your first big decision really boils down to one simple choice about what you actually want your money to do for you.
So you have to ask yourself, what's my main goal here? Am I trying to grow my initial pot of money as big as possible over many, many years? We call that growth. Or am I looking for my investments to pay me a regular stream of cash along the way? We call that income. And this table here breaks down that choice perfectly. Let's take two really popular Aussie ETFs. On one side, you've got VAS. It's all about growth. It just buys you a slice of the top 300 companies in Australia. Super diversified, super cheap fee. On the other side, you have VHY. It's built for income. It hunts down companies that pay out big dividends. But notice, the fee is higher, and it's much more focused on just a few big names.
And this chart really drives home that trade-off. To chase that high income from VHY, you're making a big bet. Look at that. More than 60% of your money is just in two spots, finance and mining. We're basically talking about the big banks and the big miners. Now, that's not automatically a bad thing, but you have to know that you're taking on more risk by concentrating your money like that.
All right, you've bought your ETF, you're feeling good, and you might think the hard part's over. But hold on, because there is a nasty little tax trap that catches so many Australian investors, and it can seriously cost you if you're not paying attention.
So let me paint you a picture. At the end of the financial year, your ETF pays you a distribution. You check your bank account, and boom, $90 in cash has landed in your account. Seems simple enough, right? You just tell the ATO you got $90 and call it a day.
Nope. Wrong. And I'm not exaggerating when I say this is the single biggest, most expensive mistake new ETF investors in Australia make year after year. It all comes down to a quirky part of our tax system that you absolutely have to understand.
It's all because of this thing called the AMIT system. A bit of a mouthful, I know. But here's how it works in plain English.
Your ETF might actually earn $100 for you during the year. But for a bunch of technical reasons, it only pays out $90 of that to you in cash. Here's the kicker. The ATO says you have to pay tax on the full $100 that was earned for you, not just the $90 in cash that you actually received.
So what about that extra $10 you pay tax on but never saw? Well, it's not gone. Here's the key takeaway, the thing you have to remember. That $10 gets added to what's called your cost base. As you can see here, when you eventually sell your ETF years down the track, doing it the right way means your starting cost is higher. A higher starting cost means a smaller profit, which means, you guessed it, a smaller tax bill.
And hey, don't just take it from me. As accountant Irene Zhu points out, this one thing is the source of most of the mistakes she sees. So the message here is crystal clear. Do not just look at your bank account. You have to wait for your official annual tax statement from the ETF provider, and you must keep track of these little adjustments every single year.
Okay, I know that tax stuff was a bit much. It can feel really heavy. But here's the good news. You don't need to be a tax wizard to win at this. Successful long-term investing really just comes down to building 3 very simple, very powerful habits.
Your first key to success is all about taking emotion out of the equation and putting your investing on autopilot. It's a strategy called dollar cost averaging. Look at how this works. You just invest the same amount of money, say $100, on a regular schedule. When the market is down and shares are cheap, your $100 buys you more. When the market is up and shares are expensive, it buys you less. Over time, it just smooths everything out and stops you from making panic decisions.
So, let's wrap it all up. Here's your simple toolkit for success. Number 1, use dollar cost averaging. Invest consistently no matter what the market is doing. Number 2, keep it clean. Keep simple records, especially those all-important annual tax statements we just talked about. And number 3, play the long game. Investing is a marathon, not a sprint. There will be bumps, but history is on your side.
And that really brings us to the most important point of all. For someone like you who's investing for the long term, the biggest risk isn't some scary market crash. No way. The biggest risk is jumping into a game without knowing the rules. But now, you know the rules. So the only question left is, are you ready to play?